You are not going to want to miss this video. Who else is finding something called the Hindustan Times, right? To get foreign views on what's going on in America is very important because they're outside of the machine giving us a different perspective. It says right here, the US Treasury is set to unleash a tsunami of bonds, and Wall Street also warns of market unreadiness. Hit that subscribe button. Do not leave this video. You will want to hear all of this. So like I said, as the Treasury prepares to issue a wave of new bonds following the debt ceiling, Wall Street voices concern about market preparedness. And let me be very clear here. This is going to have a big effect on the markets. And I don't hear that many people talking about it this clearly. So one thing that's really important to realize is that they are going to unleash a tsunami of new bonds to quickly refill its coffers. Coffers being their account. Not good for markets. Let's get into why. This will be yet another drain on dwindling liquidity as bank deposits are rated to pay for it. And Wall Street is warning that markets aren't ready. Another drain on dwindling liquidity. And one thing that we know is the amount of liquidity in the system directly affects the value of stocks and every market you can think of. The negative impact could easily dwarf the after effects of previous standoffs over the debt limit. The Federal Reserve's program of quantitative tightening has already eroded bank reserves, while money managers have been hoarding cash in anticipation of a recession. Did you catch that last part? Money managers hoarding cash in anticipation of recession. Recession's not even the big word. We all know that's coming. They're hoarding cash. That's another big suck of liquidity, money sloshing around the system, which brings down the value of everything. JP Morgan, strategist, whatever that name is, estimates a flood of treasuries will compound the effect of QT, quantitative tightening, on stocks and bonds. It'll compound the effect, knocking almost 5% off their combined performance this year. That may not sound like much, but that is a shitload. Citigroup macro strategists offer a similar calculus showing a median drop of 5.4% in the S&P 500 over 2 months could follow a liquidity drawdown of such magnitude and a 37 basis point jolt for high yield credit spreads. Who am I? Whatever. I think that this is extremely low in what it's going to knock off of the S&P. If that's all it knocks off the S&P, this isn't even worth talking about. Check this out. The sales are set to begin Monday. And they will rumble through every asset class as they claim an already shrinking supply of money. That's the liquidity, the slosh we're talking about. JP Morgan estimates a broad measure of liquidity will fall 1.1 trillion from about 25 trillion at the start of 2023. That's gigantic. This is a very big liquidity drain, says, go ahead, try to pronounce the name. We have rarely seen something like that. It's only in severe crashes like the Lehman crisis where you see something like that contraction. Again, 1.1 trillion because that's roughly how much in bonds she wants to sell. And when you sell bonds, you're exchanging them for cash. So the cash, a lot of that cash is going to go into the Federal Reserve, into the TGA, the Treasury General Account, like their checking account with the Fed, savings account, maybe more like it. So it's a trend that together with Fed tightening will push the measure of liquidity down at an annual rate of 6% in contrast to annualized growth for most of the last decade. And let's be clear, the U.S. has been relying on extraordinary measures to help fund itself in recent months as leaders bickered in Washington. The measure broker between Biden and McCarthy limits federal spending for 2 years and suspends the debt ceiling. We already know that. It says, with default narrowly averted, it was never going to happen. It was never going to default. The Treasury will kick off a borrowing spree that will, by some Wall Street estimates, could top 1 trillion by the end of the third quarter, starting with several Treasury bill auctions on Monday that total over 170 billion. Wow. So what happens as the billions wind their way through the financial system isn't easy to predict. No, it isn't. But it's liquidity, money, getting drained out of the system. Literally never good for asset prices. Stocks are what? Assets. There are various buyers for short-term Treasury bills, banks, money market funds, and a wide swath of buyers loosely classified as non-banks. These include households, pension funds, and corporate treasuries. Banks have limited appetite for Treasury bills right now. That's because the yields on offers are likely to be able to compete with what they can get on their own reserves. So that also leads us bearing the question, what will be the rate? What will be the rate on the various Treasury bonds that the government is going to pay? What is going to be the rate that the various buyers are going to get in yield? But even if banks sit out of the Treasury auctions, a shift out of deposits and into Treasuries by their clients would wreak havoc. Yes, it would. Citigroup modeled historical episodes where bank reserves fell by $500 billion in the span of 12 weeks to approximate what will happen over the following months. Any decline in bank reserves is typically a headwind, says Dirk Weiler. Sounds like a porn name. Citigroup Global Market Inc.'s head of global macro strategy. The most benign scenario is that supply is swept up by the money market mutual funds. It's assumed their purchases, outside of you and me, from their own cash pots would leave bank reserves intact. Historically, the most prominent buyers of Treasuries, they've lately stepped back in favor of better yields on offers from the Fed's reverse repurchase agreement facility, reverse repo facility. And the repo facility, it's a very strong chance, I think it's a good probability anyways, that there will be a better yield on the reverse repo than the actual Treasury bills. So that leaves everyone else, the non-banks. They'll turn up at the weekly Treasury auctions, but not without a knock-on cost to banks. These buyers are expected to free up cash for their purchases by liquidating bank deposits. You getting that? Liquidating bank deposits, exacerbating a capital flight that's led to a cull of regional lenders and destabilized the financial system this year. Can you say bank crisis? The government's growing reliance on so-called indirect bidders has been evident for some time, according to Althea Spinozzi, a fixed income strategist at Saxo Bank A/S. Okay. In the past few weeks, we have seen a record level of indirect bidders during US Treasury auctions, she says. It's likely that they'll absorb a big part of the upcoming issuances as well. She's saying that because she hopes that's what happens. That would be best for her and her bank. For now, relief about the U.S. avoiding default, which was never a real concern, has deflected attention away from the looming liquidity aftershock. Yes, it has. Was that the intention all along? In my opinion, that was certainly a factor. At the same time, investor excitement about the prospects for artificial intelligence has put the S&P 500 on the cusp of a bull market after 3 weeks of gains. Meanwhile, liquidity for individual stocks has been improving, bucking the broader trend. That is not really true, in my opinion. Out of the S&P 500, less than 10 of them are positive, significantly positive, on the year. Most of the gains by far, I'm talking 80-90% of the gains in the S&P 500 on the year come from about 5 stocks. Apple, Google, Microsoft, Nvidia, Amazon. Meta's probably mixed in there too. So that hasn't quelled fears about what usually happens when there's a marked downturn in bank reserves. Stocks fall and credit spreads widen, with riskier assets carrying the brunt of losses. I love my crypto. It will get punched in the balls. It's not a good time to hold the S&P 500, said Willer, whatever his name. Despite the AI-driven rally, positioning in equities is broadly neutral, with mutual funds and retail investors staying put. Quote, "We think there will be a grinding lower in stocks and no volatility explosion because of the liquidity drain." You wish. You know that that's possible. Berenberg's head of that's this guy. "We have bad market internals, negative leading indicators, and a drop in liquidity, which is all not supportive for stock markets." No, it's not. I agree. And it's not even that I agree. It's a fact. 100% of the time, when those things line up, not good for asset prices. Stocks are what? Assets and kind of gambling instruments. All in all, we are going to continue to have a liquidity drain. Let's add them up. We have the Fed still doing quantitative tightening to the tune of about $95 billion per month. We have interest rates where they may pause this month, but I do believe that they will end up increasing interest rates again. Best case, they just pause, and they aren't going to be lowering them anytime soon unless something real nasty happens that forces them to cut, and we don't want that either because that doesn't send prices up. So that's liquidity drain number one. And again, we all agree, everyone on the planet agrees and knows that the less liquidity sloshing around, the lower asset prices. That's liquidity drain one. We have banks tightening their lending to a significant degree, the most we've seen since the great financial crisis in 08-09. Okay, so that is way less money sloshing around, way less new money creation, way tighter lending standards. That's a big deal. That's like the Fed raising interest rates by like another half point to a point. And now we have the Treasury that's going to be methodically, systematically, continuously sucking money out of the market also by selling Treasury bonds into the market, sucking that money up. And one of their first things is to refill the TGA, the Treasury General Account, with the Fed, fill up their savings checking account, which to the tune of $500 to $600 billion. Liquidity going down for the foreseeable future. But if you think the S&P is going to 10,000 by the end of the year, be my guest. Hit the subscribe button if you dare. Be well.